Look at a stock that plummeted from $83 down to pennies, but is suddenly surging over 10% today. I want you to ask yourself, is this a falling knife, a glaring sell signal, or maybe the most undervalued strong buy in the market right now?
Oh, it's the ultimate financial Rorschach test, right? You look at this chart and you basically just see exactly what your own risk tolerance allows you to see.
Yeah, exactly. Well, welcome to today's deep dive. Today is April 17th, 2026, and we are stepping into the absolute wild west of the stock market to look at Eightco Holdings Inc.
Right. Trading under the ticker symbol ORBS.
Yes, ORBS. And real quick, if you're watching, make sure to like the video, subscribe to our YouTube channel, and it's actually compulsory to leave us your feedback in the comments. Tell us what you think.
We definitely want to hear if you guys are seeing what we're seeing on this one.
For sure. So our mission today is to dissect the financials, untangle the technicals, and really get to the bottom of this fierce bull versus bear debate surrounding ORBS.
It's one of the most polarizing setups out there.
It really is. We're going to try and figure out how a company's actual business operations could be losing millions while its balance sheet looks like, I don't know, a Silicon Valley treasure chest.
Yeah, and that structural that's the whole story here, honestly.
Right.
Eightco is it's no longer functioning like a traditional operating business. It has effectively morphed into a high beta proxy vehicle.
A beta proxy vehicle. Break that down for the listener.
Sure. So for anyone unfamiliar, high beta just means it moves with extreme amplified volatility compared to the broader market. It swings wildly.
Like a roller coaster.
Exactly. And proxy vehicle means investors aren't really buying it for what the company actually does anymore.
Right. They're buying it for what it holds.
Spot on. They want exposure to the assets in its treasury, specifically, in AI and cryptocurrency.
Right. So to understand why that shift happened, we have to look at the historical context.
Yeah.
Because the sticker shock on this stock is just staggering.
It's brutal.
Let's look at the 52-week range. Within the last year, you guys, this stock hit a high of $83.12.
Which is a solid valuation.
Yeah, but then the floor didn't just fall out. It literally evaporated. It went all the way down to a low of about 74 cents.
Ouch.
Right. Think
Yeah.
about the psychology of that. An $83 stock turning into pocket change.
Yeah, it's a 99% wipeout.
And today is trading at little $1.26. Now that's a 10.55% gain just on the day, which sounds like an amazing session if you just bought yesterday.
Sure, double digits in a day is great.
But zooming out from $83 down to a $1.26, I mean, it's a bloodbath.
It really is. When you see a 99% wipeout in a 12-month window, standard market logic just dictates that the underlying business model has fundamentally failed.
Yeah, it screams bankruptcy.
Exactly. Traditional institutional investors look at that chart, they assume bankruptcy is imminent, and they just walk away.
And if you glance at their income statement, you can see exactly why Wall Street abandoned ship on this one.
Oh, the income statement is ugly.
It's rough. Looking at the trailing 12 months, they brought in $43.12 million in revenue. That's real money coming through the door.
Right. They do have a top line.
But the net loss, a staggering negative $32.07 million.
Yeah, and we need to break down the mechanics of that loss because it tells a very specific story.
Go for it.
It's heavily driven by stubbornly high operating expenses. We're looking at $13.83 million right there just to keep the lights on and pay the staff.
Just baseline OPEX.
Right. But the rest of it is weighed down heavily by what we call non-cash accounting accruals.
Okay, let's pause there for a second. Explain non-cash accounting accruals to someone who, isn't a CPA. Are they actually losing that money from their bank account?
Yes and no. Non-cash accruals are essentially paper expenses.
Okay.
So imagine a company buys a massive server bank. They don't report the entire cost on the day they buy it. They spread that cost out over years as the equipment loses value.
Right, that's depreciation.
Exactly. Or they might be compensating their executives with stock options instead of a cash salary. So no physical cash leaves the company's bank account today for those things, but accounting rules require them to record it as an expense.
Which drags down the reported net income.
Precisely. So the $32 million loss is terrible, don't get me wrong, but it's not quite the same as physically burning 32 million paper dollars in a fireplace.
That makes sense, but it's still a pretty grim picture. I look at this cash burn rate like trying to heat a massive mansion with all the windows wide open in the middle of winter.
That's a great analogy.
Right. Like the $43 million in revenue is the furnace working overtime, but the operating expenses and those accruals are a freezing draft, just completely canceling it out.
And then some.
Yeah. And the end result is an earnings per share sitting at a dismal negative $4.14. So here's the million-dollar question.
Let's hear it.
If the income statement is a crime scene, standard math says they should be bankrupt by Christmas. But they aren't. In fact, like I said, the stock is up 45% recently. What mechanism is driving buyers back into this thing?
The mechanism is a complete pivot in market attention.
What do you mean?
The buyers driving this recent surge are willfully ignoring the income statement.
They just don't care about the mansion with open windows.
Exactly. They are looking past the freezing mansion and focusing entirely on the deed to the property. Eightco's treasury holdings were now the sole driver of its valuation.
Okay, that brings us to the balance sheet, which honestly looks like it belongs to an entirely different company.
That's wild.
As of the end of Q1 2026, ORBS is sitting on roughly $326 million in quote-unquote fair value assets.
$326 million.
That number is mind-bending when you compare it to a company trading near $1 a share. Let's break open this treasure chest for the listener.
Let's do it.
First, they have a $90 million equity stake in OpenAI.
Which is huge.
Then, they hold 277.2 million WorldCoin tokens.
Yeah.
And get this, that is roughly 9% of the entire circulating supply of WorldCoin.
A massive position.
Add to that 11,068 Ethereum tokens. And finally, $109 million in pure liquidity, just cash and stablecoins.
And their liabilities are incredibly low to offset that. The debt-to-equity ratio is sitting at just 4.63%.
Wow, so practically zero debt.
Right. They aren't leveraged with massive bank loans. They outright own these assets.
Okay, let me stop you there because the math gets really tricky here, and I have to push back on this treasure chest narrative.
Fair.
If they have $326 million in assets, almost no debt, and over $100 million in highly liquid cash and stablecoins, why is the price-to-book ratio, the PB, sitting at a microscopic 0.25?
Right. It seems broken.
Yeah. Essentially, the market is looking at a dollar bill held by Eightco and saying, I'll give you a quarter for it. Is the market just completely failing to price this correctly?
It's not a failure to price, actually. It's a deliberate calculation of risk by the market.
Okay, unpack that for me.
The market applies a severe risk discount to these assets, and it comes down to a concept called slippage, combined with extreme market depth issues.
How does that actually work in practice? Like, give me a scenario.
Sure, let's use that WorldCoin holding as an example. They own 9% of the circulating supply. On paper, at today's token price, that equals a massive dollar amount. But if Eightco suddenly needed to liquidate that position to cover their operating losses...
Which they are bleeding every quarter.
Exactly. They couldn't just dump 277 million tokens on a crypto exchange tomorrow.
Right, because who is on the other side of that trade buying them?
Spot on. There just aren't enough buyers at the current price to absorb that much supply. Think of it like trying to empty an Olympic swimming pool through a single garden hose.
Oh, that's a really good way to picture it.
The volume of water is there, but you can't get it out fast enough without the whole system backing up. If they try to force the sale, the sheer weight of their own sell orders will crash the price of the token.
So they would basically destroy their own portfolio's value just by trying to sell it.
Exactly. So the fair value of $326 million is somewhat of an illusion. The actual realizable cash value in a liquidation scenario is vastly lower.
And what about the OpenAI stake?
Well, the OpenAI stake is private equity. It's incredibly illiquid. You can't just sell shares of a private company on a Tuesday afternoon if you need to make payroll.
So they are essentially a whale, but a completely stranded whale.
Yes.
The market is discounting that $326 million because a 20% swing in the crypto market, which, let's be honest, happens all the time, could wipe out tens of millions of dollars of that balance sheet over a weekend.
Precisely why the PB ratio is 0.25. The market demands a massive margin of safety when dealing with illiquid and highly volatile assets.
Okay, so because of this violent disconnect between the terrible business operations and the massive, albeit discounted, balance sheet, the stock chart has become a complete battlefield.
Total tug of war.
Buyers see a 25-cent dollar. Sellers see a failing business. Where are we sitting technically right now? Let's talk about the chart.
We are in a highly erratic pocket. Looking at the trend direction, it's really a tale of two timelines.
Okay, give me the short term first.
In the short term, the trend is officially bullish. The stock is currently trading at $1.26, which puts it above its 5-day moving average of 98 cents.
Right.
And it's also above its 50-day moving average of 0.89 cents. Moving averages just smooth out the daily price noise to show us the underlying momentum, right?
And right now, the immediate momentum is pointing up.
Yes, very sharply up. But long term, the chart is undeniably bearish. It remains trapped well below the 200-day moving average.
So it has a mountain to climb to prove this isn't just a dead cat bounce.
A huge mountain.
If someone listening is tracking this daily volatility, what are the actual levels they should be watching?
Okay, on the downside, $1.20 is your key support.
Why $1.20?
That's a level where we've seen significant volume accumulation, meaning a lot of shares changed hands there, so buyers tend to view it as a floor.
Okay, and if it breaks below that?
Below that, 99 cents is a major psychological and technical pivot.
Got it. And on the upside?
You have immediate horizontal resistance at $1.28. It's actually fighting that level as we speak. If it breaks that, the next ceiling is $1.46, which is the 1-month high.
Now, I'm looking at the momentum indicators, and they seem to be flashing some serious warning signs for anyone looking to jump in today.
They absolutely are. Let's look at the RSI, the Relative Strength Index.
Right.
The RSI measures the speed and magnitude of recent price changes on a scale of 0 to 100. Right now, ORBS is sitting at an RSI of 74.38.
And usually, anything over 70 is the danger zone, right?
Exactly. Generally, anything over 70 indicates that an asset is heavily overbought. It means the recent 45% surge has run too hot too fast.
So a pullback to cool off that momentum is highly likely.
Very likely.
And what about the MACD? That's usually the go-to for trend reversals.
Yeah. The MACD, which stands for Moving Average Convergence Divergence, basically tracks momentum by comparing short and long-term price trends.
Right.
It's sitting at 0.03. Now, on a daily chart, that actually just triggered a buy signal.
Oh, really?
Yeah. But if you zoom out and look at the MACD on a 3-month outlook, it remains heavily bearish. So again, short-term burst, long-term drag.
I find the order flow on setups like this fascinating because it perfectly illustrates human psychology in the markets.
It really does.
We are seeing high-intensity pre-market buying pushing the price up into that $1.35 to $1.40 range. Like people wake up, they see Bitcoin moving, they see AI in the news.
Right, the hype train.
Exactly, and they pile into ORBS as a cheap proxy before the market even opens. But the second regular trading hours begin, aggressive profit-taking constantly hits right at the $1.30 level.
It's market mechanics playing out in real time. Pre-market trading has incredibly thin liquidity.
Because there's just fewer people trading.
Right. Because there are fewer shares available to trade, a relatively small buy order, say, maybe just 10 grand, can push the stock price up 5%.
Wow.
So retail traders see that big green percentage at 8:30 a.m., the fear of missing out kicks in, and they buy at the open.
And then what happens?
Then, institutional algorithms and larger players use that sudden rush of retail buying volume as an exit door.
Oof.
They dump their shares into the retail demand, taking their profits, which forces the price right back down.
That is brutal. It's essentially playing musical chairs on a sinking ship. Retail traders love these fast moves. You see a stock with an average daily range of over 20%, and it feels like a casino.
But they are just getting chewed up at that $1.30 resistance wall.
Exactly.
Thin liquidity is a double-edged sword, you know. When a stock lacks deep market depth, meaning there aren't massive buy orders waiting at every penny interval below the current price the moment the buying pressure stops, the price doesn't just drift down.
It plummets.
It plummets. There are no bids underneath to catch it. That's how you get sudden air pocket drops of 20% in an hour.
That's terrifying for a regular trader.
Yeah.
Now, the income statement explains why traditional Wall Street hates this stock.
Yeah.
But the balance sheet explains why a very specific group of people are quietly accumulating it.
Yes.
Let's talk about signals and sentiment, because there is a massive disconnect between analysts and insiders here.
Oh, a huge disconnect. If you look at the traditional analysts, they are waving every red flag they can find.
What are they saying?
The consensus rating is hovering somewhere between a hold and a sell, with an average price target of just $1.50.
And their reasoning is entirely based on the cash burn, right? They run a standard discounted cash flow model, see the company burning $32 million a year, and their spreadsheets just scream, sell.
Correct. Analysts are bound by quarterly fundamental metrics. They have to justify their ratings to conservative institutional clients based on the next 3 to 6 months of operational performance.
Right, they can't wait around.
No, they don't have the luxury of waiting 5 years for an AI ecosystem to mature.
But then we have this plot twist. Over the last year, 7 different insiders have made open market purchases. And we aren't just talking about a CEO buying 1,000 shares to look confident for the board. Last month, in March 2026, Bitmine Immersion Technologies bought $77 million worth of shares at 89 cents apiece.
That is a staggering buy.
That is
Exactly. Is Eightco Holdings an incredibly undervalued proxy play for the future of tech, or is it a classic value trap that is going to bleed investors dry?
Let's build the bull case first. Give me the absolute best case recovery scenario for ORBS.
The bull case rests on runway and proxy value. Eightco recently secured a $130 million funding war chest from ARK Invest and Kraken.
Oh, wow. That is massive.
Right.
That changes the entire math on their survival.
It really does. It provides them with years of runway. It means they don't have to liquidate their WorldCoin or Ethereum at depressed prices today just to keep the lights on.
We can just sit on that treasury.
They can sit on it. And if you believe in Sam Altman's proof of human ecosystem and you think digital identity verification will become the backbone of an AI-dominated internet,
Which a lot of people do.
right, then ORBS is a direct, publicly traded vehicle to invest in that future. If crypto valuations rise, that 0.25 price-to-book ratio will eventually be forced to correct upwards by sheer market pressure.
I can definitely see why the bulls are digging in on this. But every moonshot has a dark side. Let's look at the bear case. What is the worst-case scenario where this continues its long-term downtrend?
The bear case is entirely defined by regulatory risk, and it's an existential threat. We mentioned WorldCoin earlier.
Yeah, 277 million tokens.
Right. Well, WorldCoin deals in biometric data, specifically scanning human irises to verify identity.
And governments historically do not like private corporations building global databases of human biometrics.
Exactly. The regulatory scrutiny on iris scanning is globally intense right now.
I can imagine.
If the European Union brings down the hammer with GDPR privacy laws, or if the U.S. SEC decides to aggressively sanction biometric crypto projects,
Then what happens?
that $277 million WorldCoin asset on the balance sheet could effectively go to zero overnight.
Wow.
It's the sword hanging over the company's neck. One major regulatory crackdown, and the treasury gets disproportionately devalued.
And if those assets lose their value?
All you are left with is an operating business burning $32 million a year.
So it really is trap versus treasure.
Right.
I look at that $109 million in pure cash and stablecoins against a market cap of practically nothing, and part of me argues it's just too cheap to ignore.
It's a tempting thought.
Right. If Bitcoin and Ethereum hold their ground, buying those assets at a 75% discount through ORBS feels like an arbitrage opportunity.
But a discount is only a steal if the asset isn't legislated out of existence.
Fair point.
The regulatory environment makes it a potential value trap. You might think you're buying $326 million in assets, but if the ecosystem gets sanctioned, you are catching a falling knife with no handle.
Given all of this, the cash burn, the massive treasury, the thin liquidity, and the regulatory threat, how should a listener process this chart today? Give us the outlook.
In the short term, brace for continued violent volatility.
The roller coaster continues.
Yeah. The technicals suggest we will likely see another test of that $1.30 to $1.40 resistance zone in the coming days, driven by that pre-market momentum we talked about. But because the RSI is so overbought, expect a rejection there, followed by a pullback and potential consolidation near the $1.20 support level as things cool off.
And long term?
Long term, however, the technical charts and the income statement are almost secondary. The 3 to 5 year trajectory of Eightco entirely depends on the global regulatory environment surrounding AI and Web3 biometric data.
And this is where we have to explicitly remind everyone. This deep dive is just two geeks debating the data.
Very true.
We are looking at the SEC filings, the historical charts, and the macro environment. This is absolutely not financial advice, so please do your own robust research before even thinking about jumping into a stock with a 20% daily trading range.
Yeah, the volatility here is structural, it's not accidental. The risks literally cannot be overstated.
It is a situation where the bulls and the bears both have highly credible, mathematically sound arguments.
They really do.
And I want to leave you with one final thought to mull over as you digest this. We've talked about the freezing mansion of their operations, the massive treasury, and the severe risk discount.
The whole picture.
But think about the fundamental nature of what this company has actually become. If a corporation's treasury assets are worth infinitely more than its actual business operations.
Are you even investing in a company anymore?
Exactly. Or are you just buying a very volatile, publicly traded crypto wallet? Think about that next time you look at the chart.
A great question to end on.
Let us know in the comments, are you team bull or team bear on ORBS? Thanks for joining us on this deep dive, and we'll see you next time.